Hey everyone, welcome back to FinTech Talk. Today we're diving deep into the thrilling world of IPOs. Ever wondered what it takes for a company to go public, and what if an IPO doesn't go as planned? We'll explore the drama-packed IPO journey, including some interesting facts about tech giants like Tesla and Facebook when they went public. Buckle up because we're about to unravel it all. Let's start with the journey of an IPO. Imagine a company decides to go public and offer its shares on the stock market. The process begins with company owners and their financial advisors creating a comprehensive document called a prospectus. This prospectus is like a detailed brochure about the company, its business model, financial health, and the specifics of the offering. It is essential for helping potential investors decide if they want to buy in. Next, the company submits this prospectus to the Securities and Exchange Commission, SEC. The SEC's job is to review the document to ensure that everything is transparent and that all necessary information is disclosed. Think of this as the company's way of getting a green light to proceed. The 2019 WeWork case serves as a prominent example of how SEC scrutiny can affect even high-profile companies seeking to go public. The IPO filing encountered intense examination, with the SEC highlighting concerns over the company's financial losses and questionable management practices. Ultimately, the IPO was withdrawn. Once the SEC gives the thumbs up, it's time for the roadshow. This is where the company's executives and underwriters hit the road, pitching the stock to potential investors. They gather indications of interest, IOIs, from investors, which specifies show how many shares they're interested in and at what price range. This stage is crucial for understanding market appetite and gauging potential demand. Based on feedback from the roadshow, the company and its underwriters set the final share price. This price is crucial. It must be appealing enough to attract investors while meeting the company's capital needs. Once the price is finalized, investors are informed and out the share cost and allocation details. They confirm their purchases and make payments, completing the pre-IPO phase. Note that all shares are sold to investors, and companies receive funding before they reach the secondary market, or what we call stock exchange. On the IPO day, the company officially goes public. Stocks are listed on major exchanges like the NYSE or NASDAQ. The real action kicks off. Investors who snagged shares in the primary market now have the chance to trade them in the secondary market. However, many choose to hold on to their shares for a few months to help stabilize the market. Their price can fluctuate significantly based on market sentiment, economic trends, and company performance. Sometimes, the IPO frenzy creates a situation where shares are in high demand but scarce in the secondary market. Take Tesla's 2010 debut and Facebook's 2012 launch, for example. Both IPOs were oversubscribed, with eager investors clamoring for a piece of these tech giants. In those early days, shares were tightly held by institutional investors and insiders, leading to a scarcity that drove up volatility and caused wild price fluctuations. On the flip side, there are cases where not all shares are sold before the offering date, leading to raising lower than expected funds, potentially derailing their projects. Company might lower the share price or reduce the number of shares. If demand remains tepid, the IPO could be postponed or even canceled. For instance, Blue Apron's 2017 IPO struggled with weak demand, leading to a lackluster performance in the secondary market. For retail investors, IPO day is a thrilling opportunity to start buying shares. You can place your order through a brokerage platform, whether that's a traditional brokerage firm or an online trading service. You have options like market orders, which buy at the current price, or limit orders, which buy only when the price hits your target. Your brokerage routes your order to a trading firm or market maker. These are firms that provide liquidity to the market by continuously buying and selling stocks. Once the order is executed by a trading firm, the stock exchange processes the trade, confirming the transaction details and ensuring the shares are transferred from the seller to the buyer. The exchange records this transaction and updates the public order book to reflect the new share prices. And there you have it, a comprehensive look at the IPO process, who's buying shares before and after, and what happens if an IPO doesn't go as planned. If you enjoyed this deep dive into the stock market, give us a thumbs up. Subscribe for more financial insights, and drop your questions or comments below. Thanks for tuning in, and see you in the next video.